Good morning, everybody. This is Patrick MontesDeOca with the Equity Management Academy Live Trading Room. Live streaming from TicketTalker. Let's jump right into the gold market here. We've had some pretty good activity overnight here. Gold is trading up about 270 at 1731.32. Silver is up about 47 cents. 28.93. We made a high of let me see here what we're looking at. $17.57.40, and silver has made a high at 27.1750. Bitcoin is up 278, up about 6-7%, and it has activated a buy trigger, obviously from that buy one level of 44.77. We have the markets moving this morning on the basis of the stimulus package seems to have gone through. I think we have one more stop, but I think it looks pretty good, and so the market is beginning to react, including stocks, pretty strongly to the upside. The E-mini is up 68 points as I'm looking at the boards here. And we have the derivatives in gold GDX up 31. Crude oil is about unchanged, and Nugget up 123. So we have the derivatives on the precious metals up this morning. I believe leading the way to the futures markets. What we had here, over the last couple of weeks has been a really unusual situation with regards to the silver market. And on this segment, what I would like to explore basically is the price movement in the silver market here on the face of what appears to be a shortage developing here. And I want to take a look at the bigger charts here. Let's take a look at silver for a minute. And on the chart, get me out of the way here. On the left, you're looking at the daily numbers coming into for today. And on the right side of the chart, you're looking at the weekly pivots coming into today. Now, if you noticed, the silver market recently has made a high at 28.42, which was right into the area of distribution of supply, as identified by the VCPMI. But let me take a look at the daily. And I want to go back here to the day the silver market made the high of 30.43. 30.35 was the high that was made on February the 1st. And this is the day that pretty much Reddit, Wall Street Bets raided the internet with short squeezing basically GameStop, AMC, some of the primarily heavily shorted stocks, and begin to move into the silver market, making calls of $1,000 silver and, short squeeze, short squeeze, short squeeze. The market made a high of 30.35 on February the 1st and reverted immediately into what made a low of 25.93 on the 4th within 3 days. And so this is a very good example of not following the herd. I keep saying the VCPMI is a contrarian indicator, and it probably will be telling you to sell when everybody is telling you to buy. And up here, if you look at the reports that we published and comments made in my private trading room, my traders know that we pretty much were looking at the area up here to be a distribution of supply area, where the VCPMI identifies the possibility that this is an area where we can identify selling or supply come into the market. Mathematically, this move up here was at the extreme above the mean. The other factor that I believe took place is that the short side of the market got caught by surprise on this move, did not really anticipate that the Reddit group or Wall Street Bets were going to have such an impact. Initially, they did, and it became a global issue, a global headline. And I tell my subscribers that whenever you see headlines hit the internet or hit major newspapers or major news engines, it's usually time to be looking the opposite direction. And we took out, I came in long, my subscribers came in long, and I took out my long position here. And I went on pretty much on a hedging basis. And we hedged the position with another derivative that we use, basically, as opposed to any complicated strategy, which is simply the opposite side of the bull ETN of Nugget, which is dust. Now, when you're trading these instruments, you want to be aware that these instruments are to be traded short term. You don't want to hold on to these instruments long term. And, if you buy them at 18 and the market rallies up to 24, meaning the gold market comes down, this is bullish for this bearish ETN. And then we use this to hedge our position. And what I try to do here for my subscribers is basically teach and show how this trading tool can be applied as a GPS for your trading. It can guide you depending on whether you're a day trader, swing trader, or a position trader. It gives you the highway of profits. And if you follow the discipline, they will be targets met, completed, that essentially result in, a 300% increase in profits as we produced that last year, one of our model accounts. And this period here that basically we're talking about in silver is very difficult to understand for most traders. That how is it possible that the silver market can come down in price when there's a short squeeze? And when you ask that question, you have to take a look at the players that are in the market, basically. And what you'll see is that, number one, when you take a look at the options in the silver market, particularly at expiration date, they have a lot of influence in the market depending upon the volume of calls to puts. The put and call ratio becomes very important on expiration date. And what we saw here was that there was a large number of traders that want to take delivery of the futures markets. We seem to be running into what I believe is a real serious situation with regards to the supply of physicals, gold and silver. And there seems to be a tightness of cash. You cannot buy physical silver or physical gold without having to pay a premium and waiting a long time. For most traders that are self-directed traders, you can obtain a lot of this information on the internet. Just Google, short squeeze, or Google commitment of traders report, shadow stats, if you really want to take a look at the market from an independent point of view, outside of the government figures that I believe are skewed to justify their means. And I, as a trader, I want to take a look at the anomalies that are going on, at the discrepancies that are going on. And obviously, it doesn't make any sense that the futures price of silver and gold is coming down during a short squeeze or a cash tightness of supply. What I'm beginning to hear is that the U.S. Mint may close for 30 to 60 days as of the 1st of April. And you can go to their website and you can see their announcement there. Most mints around the world are stressed out with so much global demand beginning to show up in the cash market. And so when you take a look at the other side of the trade, always, I mean, when there's a buyer, there's a seller. It's a zero-sum game. This is a simple zero-sum game. For every buyer, there has to be a seller. For every seller, there has to be a buyer. The difference is that the amount of sellers that come into the paper market are artificial in order to contain the prices of the strikes that are anticipating the market to close at 28, 27.50. Any strike below 28 was wiped out completely by the amount of paper supply that came into the market. That if you take a look at the COMEX, the data in the COMEX, just before delivery or notices of delivery were made, JP Morgan and two or three of the largest central banks was shorting the paper market, was shorting futures 7-1 on the deliveries. That's the number that it's showing, 7-1. Now, why would anybody be shorting 7 times the real availability of physical silver on an annual basis? It's I just can't explain, except that obviously if you take a look at the price collapsed. They were able to break gold down to 17, in the low 1700s in silver. Into that 2616 area. So, for a regular trader, it's very difficult, particularly for those Reddit guys that followed that advice. They got slaughtered. It dropped more than $3. $4 since the high was made. The markets always kind of tend to go more than you would like to. So we came down below the daily extremes into that 2616 low. We came down into almost the 9-year cycle moving averages, which indicates the contrarian logic of the VCPMI that essentially told you that you want to cover any shorts, if you had any, or any strategies that were on the short side, hedges, whatever, puts, short calls, that you want to cover on that correction. And that's what we recommended last week. To cover any short strategies or logic into this move that does not make sense from an economic point of view. Some of the premiums that I am hearing are being charged in silver sometimes are $8 above or $10 above the spot price. When you're looking at $26 silver, wow, that's a pretty huge premium. And that's what people are willing to pay. So, what I'm beginning to see is that regardless of this effort that we see by the central banks to control the market and, in terms of the prices that they want to see, so that when they cover their short positions here, they'll bring the price down to enough of a price level, or they bring it down to an extreme below the mean, which is what happened last Friday, and they come in and buy physical at that point to cover their positions. They exchange it for physical. And that's been going on, I think, since the uptick rule was lifted back in 2012, where they literally allowed the algorithms to consistently be selling the market, pounding the market, shorting the market, without the ability of an uptick rule that may be able to help some of this some of these longs, and they've been pounding the market just like they did on Friday since 2012. And it's pretty clear that, what we saw here at expiration on these options, this recent options expiration, was a way for them to control the price to the level that literally they wiped out all of that premium, speculative premium. So you want to be careful not to listen to the herd, not to follow the chatter, because that's when you're going to get slaughtered. You want to be able to do your own work as much as you can, and go as far as you can. And then when you get to a point where you need to get some education, that's when you do that. But the thing that I have learned that I can share with you over these years is that the less, for me, I hear the chatter, the more money I make. And it doesn't mean all the time, because it's not a perfect science. But reducing the noise, the chatter, allows you to control your emotions scientifically, mathematically. And that's what the VCPMI does. Let's take a look at the signals here and see what they're telling us as we move into the rest of the week here. This is the daily chart, and as you see here, the daily average price for silver is $26.84. And the market is trading above that average price daily and has completed the weekly target of 27.11. So we are trading between the daily average and the weekly average, between 26.84 and 27.11. We reverted from making a low yesterday of 26.16, right above the average price. So this is bullish for the daily, as the market is trading above the daily average price, and it's going to activate a weekly bullish uptrend momentum as well on a close about 27.11. The daily signal here has activated 27.51 as the sell one level daily, with a 50-90% standard deviation relative to the implied volatility to the mean. The sell to level, 28.33 daily, with a 50-95% relative implied volatility to the mean. And this is a 2-to-1 factor. The sell one is a 1-to-1 factor. So we are in a neutral to bullish position right now as we take a look at the daily. What we see also in what I basically laid over on the VCPMI indicators is the Fibonacci trend lines. And I took the low from this move at 21.96 made on November 30th. This is the November low, to the recent high that we saw of 30.35. And we get this fan lines telling us the levels of support. and it coincides pretty much with this average price area that we're looking at. And the market come down below that, closing above it, trading above it now into the weekly average price daily. And if it closes above 27.11, it's beginning to confirm that the bearish trend that we saw the last couple of days of the week here is rolling over into what could be a bullish trend momentum. Closing above 27.11 would activate that weekly bullish trend momentum. And it also, once it does that on the close using the 15-minute bar, very systematic, it activates the target of the weekly above, which is that 2807. The sell one level is 2807. The sell two weekly level is 2949. On the gold market, we're looking at the price trading below both averages, daily and weekly. So it's been more choppy than the silver market. And I think as we take a look at the derivatives here for a minute, we can definitely see that the gold market is searching for a leader or waiting to take leadership. And so far, the silver market seems to be the one that's leading the way, and it's going to again identify the bullish uptrend on a close above 27.11. One of the comments I want to make regarding the increase in interest rates on the 10-year note last week, I believe was an indication of what the stimulus or what this policy, monetary policy of providing stimulus to the market is doing to the economy, basically, or to the purchasing power of the U.S. dollar, the intrinsic value of the U.S. dollar. And it's beginning to foretell, it's beginning to anticipate that potentially all of that is going to be inflationary. The expectations of short-term rise in interest rates obviously caught everybody by surprise, including the gold market, including the stock market. We saw a major sell-off in equities and a major sell-off in the gold market, silver market, and it allowed the central banks to cover a massive amount of their short positions. I believe, according to the Commitment of Traders report, that out of about $40 billion of risk on the short side of the market, they have liquidated about $27 billion on this correction down. So they were saved by the bell with the increase of interest rates, the increase in yields that essentially short-term spooked the market. And so when you really think about what the market in interest rates or the bond market is beginning to indicate, is that there are growing expectations of inflationary levels increasing here as we move on in the rest of 2021. We seem to be getting control on the vaccine, and it is anticipated that sometime in the fall of this year, maybe July, August, late summer, that we will get back into some kind of normality, very close to what the economy was pretty much running at prior to the pandemic. I think one of the things that we want to see, and one of the indicators that we're beginning to watch very carefully, is the increase of the CPI, which is the commodity index. And when we take a look at, obviously, at prices in grains, since March of last year, they've gone up substantially. And I keep referring to soybeans as an indicator of pretty much the cost of food, and we saw a high of 14.45 here recently. We have corn at $5.74 from $3.01 back in March of last year. We have wheat, $6.93 from $4.71 as of March of last year. And the final component is the crude oil that we saw it recently trade $63.81 from a low, which was basically a negative $37 here on the peak of March, around the end of March. So theoretically, the crude oil market has risen more than $100 already since the low in March. And that's an inflationary confirmation that unfortunately is not included in the government figures that they use to identify inflation. They don't use this economic indicators for whatever reason. They happen to be the most important ones. And this is how they are controlling. What they're looking at is inflation under 2%. Now, the reality is, if you take a look at shadow stats, and if you include the energies and commodity prices here, that we're running at about 10%, roughly. And I think that if it is reflected in the market, we could be looking at sharply higher prices in commodities in general across the board. And it's going to put a tremendous pressure for the central banks, for the Federal Reserve, to control interest rates. Because the pressure, as the economy increases in strength and accelerates, it puts the fear that interest rates may need to go higher faster than anticipated. So what we have here is a very similar situation as we had back in 1971, when interest rates exploded to 14% in 1981, and the price of gold went up to $800 an ounce, 8-to-1, while interest rates simultaneously went up to 14%. So the school of thought that the gold market does the opposite when interest rates rise no longer applies in this environment that we're dealing with. And the normal conditions where you have inflation under control, not much volatility, possibly that was that relationship. But the paradigm of the US dollar in terms of the world's reserve currency and intrinsic value is at question right now, which is why the bond vigilantes or the market are beginning to ask for more interest rates on U.S. bonds as a consequence of that risk that this whole monetary policy is going to be inflationary. Now, it's not just the United States. I want to make a point. No, we're looking at a global situation, global central banks. So global monetary policy needs to be conducive for lower rates, a must. And if the financial markets begin to dictate based on the risk of global bonds, much higher interest rates, central banks and governments will cap the long-term yield curve. They will have to. And that means basically that they will stop interest rates from going up, controlling the long end of the market, capping the long end of interest rates, which is where the risk is. If we get the interest rates to explode under 30-year bonds, which is where all of the debt is located, pretty much, can you imagine an increase in interest rates of 2-3%? What do we do to the historic debt level that we're running? That is like more like $28 trillion. So I believe what it indicates, just based on the monetary policies that continue to be Keynesian philosophy of economics, which is really to provide the market stimulus as much as it needs, devaluing its base currency with the anticipation that inflation will arise out of that and in some way bring the consumer into the economy and get some economic growth on that basis. The problem that I'm looking at is that when we're not dealing with a normal transition, from a undergrowth economy to, an economic growth above the average or above the mean economy, so to speak. We're talking about a pandemic, which was a health catastrophe that affected the supply chain, caused massive lockdowns globally, prevented consumers from reaching the market, and disrupted completely the supply and demand cause and effect reaction. So what we're beginning to see is shortages of supply. There were shortages of vaccines. There's shortages of food. We're going to begin to see possibly more shortages develop as a consequence of the velocity of money that may be coming into the system. People going back into the economy. They're dying to go back into a normal economy and have some kind of normality socially, be able to go back to the office, if there is an office still in place. We still have millions of people unemployed. And so I don't believe that we've come out of the woodwork yet in terms of what this pandemic has done to the financial markets. And I don't believe that we have seen yet the cause and effect of all of this stimulus in the precious metals prices, as it begins to identify with the possibility that all of this is going to be highly inflationary. And we're beginning to, what appears to be, see massive world demand across the board in precious metals. So there seems to be a real situation in terms of a shortage of supply in the market. But the paper markets, will wipe you out if you're trading in the paper markets, if you get too over leveraged or too over aggressive and don't have any kind of objective independent indicator that you may use outside of the chatter, that's going on, which is pretty dangerous. And so coming back here to the silver and the gold market, which is why I'm trading this very focused right now, is because I do believe that this is a real shortage that we're developing here, and the prices are going to reflect that anytime soon. Particularly as the recent options expiration took place. Let's see how and what happens here to this market as we move into March or April. But given any corrections here, I would say to you that you want to use any of these corrections to add to your long-term core position. Because if, in fact, we are looking at this, what appears to be a historic demand developing here, I don't think that we have seen yet what silver prices can do. We're looking at $26, $27 in silver. In the summertime, we might be looking at $50 in silver. August, September, we may be looking at $2,150, $2,200 in the gold market. So you want to position yourself in a way that you don't get scared by the market, that you can withstand the corrections, and look for these washouts that occur, for these corrections to occur, this pump and dump, so to speak, mentality, to position yourself, whether it be in the physical market, in the ability to get the actual gold and silver in your possession, or for you to be able to build an incredible portfolio in some of these shares, gold mining shares, silver mining shares, that are offering just an incredible opportunity. We are chopping around, obviously, the average price as the VCPMI AI identifies this area as a 50-50 standard deviation. It may chop around here as it is, up and down here for a little bit until the market makes a break at about 27.11 or a breakdown below 26.84. The E-mini has completed the target of 38.83, which is the sell one level. So if you were long here, this is what the daily indicators, and let me see here, are telling us that the sell one level is 3,900. Let me get rid of this. The sell two is 38.90. So I would, if you came in long the market, book some of those profits here, is what the AI suggests by using the VCPMI. Bitcoin, Grayscale, Bitcoin Trust, obviously activated a buy signal here this morning about 46.99, and the target that we're looking at is 46. Let's see. Oh yeah, we're looking at the weekly and buy one level almost at the same level. So this is a critical level, and if we do get the market to trade above this, it will be activating a very strong signal on a daily basis, which is the buy one level, and the weekly average price will activate the trend bullish. And so the charts look pretty constructive here. And this is another instrument that we are trading this instrument as a virtual asset. It's a fantastic instrument to trade. We recommended our subscribers in the trading room last week on the, pretty much to buy GBTC as it came into this level here, almost completing the gap, but into this Fibonacci trendline support that coincided with some of the codes that we use, which indicate the market at this level in blue is in an area of what it's called an accumulation of supply. Anytime you see the price in blue, automatically it alerts you that that area is a high probability where you can potentially are going to identify buyers come into the market. And we have reverted from there, and we're looking at a target of about 48.22. A close above that brings us all the way up to 49.63 to 50.36. On the weekly, we're looking at targets of 51.12 to 53.34. Coming back to the silver market here, a close about 27.11 is going to be pretty significant. It's going to activate a bullish additional confirmation of the weekly bullish trend momentum, and we may get some additional momentum, some additional buy-in to come into the market at that point. And the nearest target is 27.51. And if we take a look at the gold chart, it does pretty much indicate and looks like the silver is leading the way up here. Even if we use just technical conventional analysis here, we can see the trend lines being formed. And in gold here, 1746 would be a nice indication that we are moving up into this uptrend that's anticipated to close above 1754. And if we add the Bollinger Band, you can see the market reverted right below or from that lower band. And moving towards the upper band, which coincides with this downtrend line, into this area of daily and weekly average prices here. So, this is how I measure, you might say, the shorter term indicators by applying conventional indicators into the code, and it gives me a pretty good idea when I need to execute an order based on the signals here by the VCPMI. I think that now, if we take a look at some of the work I've done here, over the last, 260 episodes, 1 hour each, I've documented pretty much the process that I've used to make $1 million last year on a model account, on the house account. And I am applying this same strategy that I'm coaching and teaching you. The difference is obviously your profile. Your profile for risk management, money management may be different than, most traders, and it should be. Not every trader is homogeneous. And so one of the benefits of the VCPMI is that we can customize this according to your profile, whether you're a retail trader, whether you're a home office, hedge fund, or pension fund. This can be customized to provide you a GPS guide for you to manage that portfolio, very much like it's doing for me. And thank you for Ticket Talker to allowing me to show you transparently how I'm doing it. Even though I'm using a simulator platform, it really doesn't matter for you as a self-directed trader how much money I'm making or how much, my clients are making, or, it's irrelevant. Because what you want to do as a self-directed individual, or what I'm trying to do here every day for an hour, is to teach you how you can become master of your own trading by the application of the VCPMI. It's not 100%, but it gives you, and it tells you mathematically, the extreme levels of the supply and demand above the market or below the market average price, which is really the bottom line when you talk about trading. What kind of markets, or what do you trade for, is basically to identify the extreme levels of that supply and demand. That's what the market is all about. And you want to be on the right side of demand and the right side of supply. Otherwise, you're going to get slaughtered if you follow the chatter, so to speak. So I'm comfortable holding my long positions. I've recommended, again, my traders, depending upon the profile, to hold long derivatives, stocks, ETFs, net long. We covered our hedges, short hedges. Let's try it, and we added to our long-term core position. And I think that's what we want to do. But be prepared. Be prepared that there can be major shakedowns here, particularly as we move into the month of March. And I think we have maybe, I would say, the most, according to the early indications that we're getting from the VCPMI, that we have maybe about 30 days before the time runs out and we begin to see a summer rally take place, unlike anything that we have seen before. And I think we're going to be testing the highs in gold of 2089, and the 2150 to 2200 target area is coming into place. And somehow the picture is indicating that it's very possible for that to occur sometime late in the summer. Unless something, else happens drastically here and it propels the price to reach those objectives a lot sooner, which can happen. Which, by the way, if it does materialize that those prices are reached sooner than expected, don't be shy. Take the profits, book it. Because corrections will unfold. And particularly in this environment where they want to control the other side of the US dollar, which in theory is gold and silver, we may see a lot of volatility back into the market at those levels. But for now, if you, again, just to reiterate, hold your longs and look for the market to trade through the extreme levels above the mean up into that 1800 actually level that I'm looking at for the next few days, for the rest of this week. I want to thank everybody again for the time to share this information with you, and I sincerely hope again that you are making sense of this and that you are becoming a better trader every day. Take care of yourself. I'll talk to you soon. Be well.
The risk of loss in trading commodity interests can be substantial. You should therefore carefully consider whether such trading is suitable for you in light of your financial condition, and considering whether to trade or to authorize someone else to trade for you. Past performance is not necessarily indicative of future results.
Folks, John Najarian here with Steve Collegian, co-founder of Ticker Talker, and here we are in Master Control. And this is unbelievable, Stephen, because this is your E-mini screen right now. Now show me what you're looking at.
So basically, I built Indicator 4 with my own predictive analytics, and as a trader, you want to be on the right side of the market. You want to be able to identify trends, reversals, and positive, negative divergences. I'm able to see divergence patterns, sell signals, picking up patterns that I'm able to fall in the
And you're able to draw right on the screen, and that goes right out to the customer.
Right to the user. The user sees it as I'm drawing, constantly hit it, erase it. I can go to the cues. I can see sell signals develop right before my eyes. First bounce on the 5-minute. You can see we just dropped 70 cents. And whether it's bonds, E-minis, NASDAQ futures, or any commodity, that gold, silver,
any future, folks, you got to check it out. Check out our link below, Ticker Talker.